Most central banks have now delivered their first rate cuts, increasing the likelihood of a soft landing. We are at a crucial point where shifts in market landscapes and risk dynamics could reveal valuable opportunities by investing in bonds. Today, I'm delighted to be joined by Paul Mitchell, our senior fixed income investment specialist. Together, we'll discuss why now is the time to adopt a dynamic approach in our fixed income portfolios. So, Paul, bond prices and interest rates tend to move in opposite directions. Does this make bonds particularly attractive for income investors, given that the Federal Reserve has already started cutting rates?
Well, yes. When central banks cut interest rates, the value of existing bonds with higher yields typically rises. So this inverse relationship can make bonds favorable for income investors in a falling rate environment. But it's the power of the combination of both income and duration, so high quality yield and duration protection, which can provide good total return prospects when combining the yield and duration performance. So with yields high and interest rates beginning to drop, we see a global total return opportunity set for bond investors. So now is a strategic time to consider bonds for both income and potential capital gains.
How much do we expect the Fed to cut rates, say, by the end of 2025? And what strategy should investors consider when managing duration during a rate cutting cycle?
Sure. Well, we expect the Fed to cut rates through the end of the year, so 24 and into 2025. However, the market keeps repricing the expected pace and the exact amount of these cuts, and these will depend on underlying economic data. Now, we don't anticipate rates will go back to zero like in 2020. Instead, they will reach a more neutral level. In 2025, in this environment, investors should consider gradually extending the duration of their bond portfolios to benefit from falling rates. However, it is important not to allocate too much duration too soon. Timing is key here, and investors are not currently being compensated for taking additional duration risk. In fact, intermediate fixed income bonds are the current market sweet spot, with duration between 3 and 6 years providing a balanced choice. So while rate cuts generally benefit fixed income, the timing and pace of these cuts remain uncertain. So economic data and geopolitical risks can influence market preferences for different durations and lead to volatility. Therefore, it's really important to adopt a dynamic approach as the rate environment evolves and to manage this risk strategically.
Indeed, we are seeing broader earnings growth across sectors and styles, which should help keep default rates relatively low. So looking ahead, which types of bonds are best positioned to offer investment opportunities?
Yeah, so corporate credit, especially high quality investment grade bonds, look favorable within this environment. These bonds tend to offer better yields than treasuries and benefit from improved credit conditions and lower refinancing risks associated with lower risks. Technicals remain supportive as the all-in yield continues to provide a strong flow of funds into IG credit, and looking at fundamentals, although off their best, they still look very healthy. Additionally, selective upgrade candidates in high yield bonds and securitized credit could be considered for diversification and enhanced yield. And in particular, securitized credit continues to offer comparatively high starting levels of income, even as rates start to decrease. And as the spreads remain wide, it could also benefit from spread compression, adding another layer of returns. So securitized credit tends to have low correlations with traditional fixed income, making it a potentially valuable component of a diversified bond portfolio.
And as history shows, no single sector consistently leads in performance year after year. So Paul, can you explain the advantages of a dynamic multi-sector approach in a portfolio?
Sure. So a dynamic multi-sector approach allows investors to capitalize on opportunities across various segments of the fixed income market at different times. So by diversifying investments, you can mitigate sector-specific risks and take advantage of different market conditions. This allows investors to avoid the first to worst phenomenon, one sector being a top performer over a period and then the bottom the next. So, for example, high yield and short duration bonds may be attractive during economic expansion when interest rates are high, and conversely, long duration government bonds may outperform if the economic outlook worsens. Therefore, dynamically allocating investments across sectors, as well as duration, is crucial for achieving returns while managing downside risks and navigating the changing market landscapes.
So in a world marked by change and uncertainty, what are the major risks to bond investors and how can we effectively mitigate them?
Sure. Well, markets can be volatile and there are various risks facing bond investors. So credit risk, the risk that an issuer defaults before maturity, market risk, the risk that a bond's value will fluctuate within the underlying market conditions, but also interest rate risk. The risk of a bond's price will fall with rising interest rates and inflation risk. So the risk that bonds' total return will not outpace inflation. But given the changing market dynamics, outsourcing and allow a specialist multi-sector portfolio manager to tactically manage duration whilst taking a holistic investment view across multiple fixed income sectors can aid portfolios. And this can help investors to balance and diversify fixed income exposures, protect principal, and mitigate volatility across these key risk factors, all while potentially generating more stable returns.
That's great. Thanks, Paul, for your insight.
Many thanks.